Engaging explanation on capital structure and solvency ratios for CMA Part 2 candidates. Imagine a theater production. Let's imagine that you're directing a blockbuster theater play. Your actors, props, costumes, and the stage setup are your assets. They make the production possible. Now, you need funds to kickstart this show. How will you arrange this? Through tickets, sponsors, or borrowing from a rich producer? This choice you make resembles a company's decision on its capital structure. Capital structure, setting the stage. Capital structure refers to how a company finances its assets, which can be either through equity, like the money you might get by selling tickets in advance or contributions from co-producers, or through debt, like borrowing from that rich producer. Companies need an ideal mix. Too much debt can mean hefty interest and repayment obligations, like being too much in debt to the rich producer and having him dictate your show's terms. However, equity means sharing ownership and possibly profits, like sharing your show's success with all those who bought tickets in advance. Enter solvency ratios, the director's binoculars. Now, let's say you want to see how well prepared you are for a series of shows. Can you weather a few poor performances? What if there's a sudden expense, like a stage prop breaking? Similarly, stakeholders want to gauge how a company is positioned to meet its long-term liabilities. Solvency ratios serve as those binoculars. 1. Debt to equity ratio, DE. This is like comparing the money from the rich producer to the funds from ticket sales. A higher ratio indicates higher leverage and potentially higher risk. Debt to equity ratio equals total debt, total equity. 2. Times interest earned, TI. Imagine if you had to pay a fee for every show to the rich producer. Can your current earnings cover that comfortably? Similarly, TI indicates how many times a company can cover its interest expenses. Times interest earned ratio equals earnings before interest and taxes, interest expense. 3. Equity ratio reflects the proportion of total assets that are financed by stockholders and not creditors. Higher ratios suggest lower risk to creditors. Equity ratio equals total equity, total assets. Mic drop moment. As future CMAs, understanding capital structure and solvency isn't just about crunching numbers. It's about gauging how a business orchestrates its show amidst risks. It's a harmony of debt and equity, with solvency ratios helping us tune into the rhythm. With this perspective, you're not just an accountant. You're the director of financial success. So, next time you see a balance sheet, picture a theater, the drama of funds, and the dance of ratios. Happy directing!